Welcome to this session of Options Basics. We'll be covering call and put option profiles. In this session, I'm going to explain 4 of the primary types of options. These 4 option types are really important because they represent all 4 positions that are outlined in any given options chain. The 4 option types are long calls, short calls, long puts, and short puts. These are also the 4 primary options that are used to create other verticals like call debit spreads or butterflies, just to name a couple of examples. I'll go over other combination options later. We're going to open up the Thinkorswim trading platform. I do recommend that you create an account if you don't have one already, or you can just follow along. Once logged into the desktop application, we go into the Thinkorswim Trade tab here. From here, we see the options chain. From here, we can pull up the option chain. This is simply a chronological record book of sorts that outlines the available options. Each chain is grouped by expiration dates. Today is the 3rd Friday of January, so this is the monthly option for January, and then this is the monthly option for February. Let's expand the 22 January option chain. Notice that there's 2 sides of each options chain. Here we see that the book is split into 2 sides, one for calls and another for puts. This is the call side here, and this is the put side. Notice the center column, which outlines the strike prices. These strike prices are listed in ascending order, so they go from smaller to larger as you go from the top to the bottom of the page. Remember the PLL Profile Chart I showed you in the last session? Each side of the options chain represents 2 separate regions on the PLL Profile Chart. This chart splits the PLL diagram in half. It splits the diagram down the center for any given strike price. The PLL chart can be split into 2 regions. The region below the strike price for market prices or the current price of the stock that are less than the strike price, and the region above the strike price for market prices that are higher than the strike price. Well, the options chain does the same thing. Just think of the call side of the options chain as the side that correspond to options that exhibit maximum profit or loss when the price ends up at or below the strike price. I'll explain this in a minute. Similarly, you can think of the put side of the options chain as the side that corresponds to options with maximum profit or loss when the price ends up at or above the strike price. I'll show you what I mean. Here's the PLL diagram for long calls and short calls. The red profile, this one here, represents the call buyer's position, and the green profile, this one here, represents the call seller's position. When a call buyer buys a long call, he is essentially purchasing it from a call seller who has taken the opposite position, illustrated by the green profile. Notice that if you flip the long call profile on the horizontal axis, that's this one, the long call, if you flip this along the horizontal axis, you get the mirror image, which is the short call position. Also notice that if the market price of the underlying is at or below the strike price of $30 at the time the option is closed or it expires, the call buyer will be at a max loss. So that's for this region here. Here's the $30 strike. We can also see that the call seller will be at maximum profit. Let's say, for example, that the market price at the time the call seller closes his position is $15. So let's say that the market price is here, $15. Tracing a line from the $15 market price to the short call profile, then to the PLL vertical line, shows that the call seller gains his maximum profit of $3. If we draw a line from the $15 position up to the short call seller's position, if we draw a line from the market price to the short call seller's profile, and then trace that to the horizontal profit and loss line, the short call seller is essentially at a $3 profit. In this example, the call buyer's $3 loss, which corresponds to, again, we're at the $15 market price position. And if you trace a line down to the call buyer's profile and trace it to the profit and loss, the call buyer has essentially lost $3. Let's look at the put option side. Notice that if you flip the call option profile along the vertical axis, so if you go back to the original slide here with the call option, if you flip it along this vertical axis, you get the mirror image of the call side. These are the put options. We have the short put and the long put. The red profile represents the put buyer's position. When the put buyer buys a long put, he has purchased it from a put seller who has taken the opposite position, illustrated by the green profile. Also notice that when the market price at closing is at or above the $30 strike, the put buyer will be at max loss, in this case at minus $3. We can also see that the put seller will be at a maximum profit. In this example, the put buyer's $3 loss goes to the put seller as credit. So let's say that the market price closes at $45. If we trace a line to the put buyer's position, if we trace a line to the put buyer's profile, the market price closed at 45, and that represents a $3 loss for the put buyer. That $3 loss goes to the put seller as a $3 credit. Note that when you choose a different strike for your option, you're trading at a different profile. For example, if you choose to trade the $50 call, as in this graph, instead of the $30 call, the PLL profile looks like this. So what does this mean? Let's say, for example, the current price of this stock is at $50 here for the call options, and $50 here for the $50 strike. These are both call options. We're comparing two different strikes, two different options with two different strikes. We're looking at the option with the $30 strike, and we're looking at the option with the $50 strike. In the first case, buying the long call at the $30 strike means that you will be buying the call option with some intrinsic value. And that's because the current market price is higher than the strike price. If you're a call buyer, your profile indicates that you're in this positive region here, and if you trace the line from the profile to the profit and loss axis, we see that you're at about a $1 profit. We can see this here. If you trace the line from the profile to the profit axis, that gives us about $1 profit. So this option is said to be in the money. But if you instead buy the $50 long call here, when the current price is at $50, the option has no intrinsic value. This is said to be an out-of-the-money option. And that's because if you trace the line from the $50 to the call buyer's profile to the profit and loss axis, we see that this gives a minus $3 loss. Let's go back to the Thinkorswim options chain. If we look at the purple region here on the call side, this region indicates that all the strike prices are in the money. That's because the current market price is higher than the highlighted chain of strike prices. So we see that the current price, for example, for AMD right now is at around $89. All these strike prices are below the current price. So all these options here are said to be in the money. That's because the current market price is higher than the highlighted chain of strikes. If we look at any strike within this area, we can see that under the intrinsic column, that would be this column here, these values are all non-zero positive. Okay, and if we scroll down, let's scroll down and look. The options chain, we see that these are all non-zero positive intrinsic values until we get here. I'll explain that in a minute. Notice also that as the strike price chains get lower, So if we go this way, here are the strikes. The strikes get smaller and smaller if you go up the chain, the higher the intrinsic value. So here we have a very low intrinsic value of 50 cents, and as you go up higher, as the strike prices get smaller, the intrinsic value gets higher. Again, that's because the difference between the market price and the strike price determines the intrinsic value. Everything in the black area here is, let's draw a different box here. Everything in this area, in the black, everything here in this black area is for strike prices that are higher than the current market price, and is why the intrinsic value for these options is 0. So if you look at the intrinsic value for these options that are out of the money is 0. For the put side, we're now looking at long puts and short puts. For the long put buyer, when the current market price is higher than the strike price, the option has no intrinsic value. That's because the long put buyer's option does not gain intrinsic value until the market price goes below the strike price. The purple region at the lower right corresponds to options that have strikes that are higher than the current market price and therefore have intrinsic value. And that would be this region here. In this session, I discussed the 4 primary option types. These are the long calls, short calls, both on the call side of the options chain. There's also the long puts and the short puts, both on the put side. I discussed the profit and loss profiles for the 2 types of call options and the 2 types of put options and how they relate to the call and put options on Thinkorswim's options chains. In the next session, I'm going to review a real-life options contract on the Thinkorswim platform. Throughout this session, I'll highlight the options characteristics and how they tie back to some of the basic concepts that I've discussed so far. Thank you for watching.